Vanguard's 2024 capital gain distributions is out, and something you need to be aware of. Absolutely, especially if you're in a taxable account. If you're in an IRA, it matters not. But if you're in a taxable account, this will be taxable income to you, and it could affect your Obamacare. It could affect a million different things. So you need to be aware of this stuff. All right, so let's dive into it. Okay, every single time I start to do a video, a guy wants to join me. Two guys want to join me. All right. So here we go, Vanguard's preliminary capital gain distribution estimate. So we're going to see right here, and we're going to make this a little bit bigger so I can see it. And we're going to go to a couple funds that you'll notice. It's too big. I want to show you something here. Oh, geez Louise. Geez Louise. So first we're going to go down to S&P 500 index fund, and you're going to notice something. Oh, wait. Huh. What? There is no S&P 500 index fund. Okay. Let's go to the total stock market index fund. Oh, there is no total stock market index fund. Why would that be? Because there are no capital gain distributions in those funds. See from Vanguard's website on VTI, the Vanguard Total Stock Market Index, which full disclosure, this is by far my biggest holding. Well, nothing but dividends. Look at that. Dividends. That's it, huh? Just dividends. No capital gain distributions. That's kind of weird. Wellington, we'll see, we have short-term capital gain. This is last year, 2023. We're going to talk about 2024 here in a second. Short-term capital gain right there. It wasn't much, but then we got long-term capital gain. It was $1.54 on a share price of $40.81. So you can see right there, that's the difference between the funds, the index funds from Vanguard, and the actively managed funds. The index funds have no capital gain distribution. That's a big deal if you're like trying to crunch your numbers to keep Obamacare and all that stuff. That's a big deal because capital gain distributions are taxed you as capital gain income. And even if you're still in the 12% tax bracket, if it puts, remember, Obamacare in terms of premium credits, they don't look at your net tax, they look at your gross tax, essentially your MAGI, modified adjusted gross income, which includes capital gains. So you might not pay tax on the capital gains, but it could be still as part of your allocation, your total income with regard to Obamacare premium tax credits. That's why you got to have index funds in a brokerage account as opposed to Wellington. If you're on Obamacare, if you're not on Obamacare, if you're on Medicare or your corporate company, that's fine. You don't have to worry about it. But if you're on Obamacare, you really need to have index funds because no capital gains. All right, so let's go back here. So we're just going to look at prime cap. Prime Cap's only going to issue 5.26% of the total shares. That's pretty good. Last year or the year before is quite. Actually, I want to show you something else. Let me back up for just a second. Selective foul. So what this means is they're going to here's Prime Cap. Over 5.25% of the entire value of the fund will be distributed to you as a capital gain. All right. So that's taxable income if it's in a brokerage account. Again, you might not have to pay tax on that taxable income, because if you're in a 12% tax bracket, there's no long-term capital gain tax. But if it's part of that short-term capital gains, you will have to pay tax on that. Hard to imagine there's much in short-term capital gains, but just be as it may. Target retirement funds, not much. You can see right here, 6%, 6 basis points on the entirety of the net asset value, not much. Here's strategic equity. Now let's look at healthcare, 9%. Anytime you're over like 6, 7, 8%, that's where it gets a little bit dicey. International growth, 8%. A, B, C, E, F, G, H, I. Healthcare, 7%. Growth in Admiral, growth in income, 9, almost 10%. Yeah, so that's not, we don't want those. Here's dividend growth. That's the one I used to own, but I had in my Roth, but 8.32%. Energy, 9.88%. Explore, 11.29%. Woo, Nelly. Let's see what else we got here. Admiral right here. Yeah, Admiral 2, Windsor 2, Wellington. So even Wellesley's got 2.7. It shouldn't be anything on bonds. Yeah, there's nothing on bonds. So you can see right there, that's the capital gain that you'll be distributed to you if it's in a broker. I mean, it's going to be distributed to you in a brokerage or an IRA. It's just a taxable event. I just want to show you something. Let's go back to Wellington. No, I want to go back to VTI. Watch this. This is why people say, they're wrong. I want to show you their VTI. All right, so we're going to see 3 basis points. It's trading at 292. I want to show you something here. Check this out. Turnover rate is only 2.2%. So they just don't generate much in capital gains. But because Vanguard has this thing with the SEC. I don't know how to do it, but they don't have to pay any capital gains. It's fantastic. I mean, you're going to have to pay it when you sell the shares, don't be wrong, but you don't get capital gain distributions. Turnover rate is low. That means it's just, you're not going to get hit with a bunch of unforeseen capital gains. Again, for ETF, it doesn't, for the Vanguard ETFs, it doesn't matter. But let's just say you had an actively managed fund. One of the things you want to look out for is the turnover. Higher the turnover, the more income you're going to have to pay. But that's not what I want to talk about. I want to show you this right here. Come down here. Look at this. Unrealized gains as a portion of NAV, $161, which is the thing is, which is 57% of the trading price right now. All right. I mean, that is buying. I mean, look at this. So it's trading at 292. 57% is that unrealized gains, which means they bought something, they just held it, and they held it, and they held it. Now, again, what does that mean? If it's a normal fund, an actively managed fund, that means the unrealized gains. Anytime an actively managed fund makes a sale, that's going to come back to you as a shareholder. Here, it doesn't work like that in ETFs or Vanguard. It doesn't. But it also shows that they don't have much turnover. I just showed you 2.2% turnover. They're just not buying and selling much. They just don't. And essentially, they're holding the shares they've had for freaking years and years and years and years. Which means what? Just allowing the market to work its magic. And this fund's up like 24% year to date. It's insane. I'm not saying you should buy it. I don't know. Are we at the end of that massive run since 2010? Dude, no one knows. I don't know. You don't know. We don't know. I'm just saying at the end of the day, this is what makes Vanguard, the ETFs, the index funds, just so great. You just hold it, very limited taxes you got to pay. I think the dividend on this guy is like 1.7 or something like that. Let's see here. What's the dividend? Yeah, 1.23. I mean, I have this as in my brokerage account plus my Roth, and I just hardly any income's derived from it. And that's exactly what you want. If you're on Obamacare, or you need to be careful of your taxes in terms of you don't want to go to IRMA and all that stuff, you don't want actively managed funds in your brokerage account. You just don't, because of the distribution of capital gains and other income as well. All right. Love your thoughts. God bless. Put them in the show notes. And Pablo that like button.